For years, strong demand was considered one of the best signs a business could see. If customers kept buying, companies expanded confidently. More demand meant more hiring, more inventory, more investment, more growth. But now, something unusual is happening across the business world. Even when demand appears strong, many companies are still acting cautious. Businesses are cutting costs during strong sales periods, hiring more slowly, reducing expansion plans, protecting cash reserves. And in some industries, companies no longer fully trust what looks like healthy consumer demand. Because modern businesses are starting to believe demand has become far less predictable than it used to be. For decades, companies relied heavily on patterns. Businesses could study consumer behavior, seasonal cycles, and economic trends with relatively high confidence. If sales remained strong consistently, companies expanded aggressively because future demand felt reliable. But today, demand can shift extremely fast. Consumer behavior changes quickly. Online trends explode overnight. Economic sentiment swings constantly. And businesses are realizing that strong demand today does not guarantee strong demand tomorrow. That uncertainty is reshaping business strategy everywhere. One major reason companies became more cautious is what happened during and after the pandemic years. Demand patterns became chaotic. Some industries experienced huge surges unexpectedly, others collapsed almost overnight. Consumers suddenly changed spending habits, shopping behavior, and priorities very quickly. And many businesses struggled to adapt. Companies that believed high demand would continue indefinitely often expanded too aggressively. Retailers ordered too much inventory. Tech companies hired too rapidly. Manufacturers increased production heavily. Then consumer behavior shifted again. Suddenly, businesses were left with excess inventory, rising costs, and operations built for demand levels that no longer existed. That experience changed how executives think. Many companies no longer trust temporary demand spikes the way they once did. Instead, businesses are becoming far more defensive. Even when demand looks strong on the surface, companies increasingly ask, is this sustainable? Is this temporary? Could consumer behavior suddenly shift again? That uncertainty creates caution. Another major reason businesses distrust strong demand now is inflation. During inflationary periods, consumer spending can become misleading. Higher revenue numbers do not always mean companies are actually selling significantly more products. Sometimes consumers are simply paying higher prices for the same goods. That creates a dangerous illusion. A company may appear to be growing strongly because revenue rises, while actual purchasing power weakens underneath the surface. Businesses understand this risk very well, and that's why many executives now focus heavily on consumer behavior trends instead of raw sales numbers alone. Companies are watching whether customers are trading down to cheaper products, buying smaller quantities, delaying purchases, reducing unnecessary spending. These signals matter because they reveal whether demand is genuinely healthy or simply inflated by rising prices. There's also another important factor: consumer confidence has become unstable. Modern consumers react very quickly to economic uncertainty. Interest rates rise, spending slows, layoff headlines appear, confidence weakens, fuel prices jump, households cut back elsewhere. And because information spreads instantly online, consumer psychology shifts faster than before. Businesses now operate in an environment where demand can weaken rapidly, even if broader economic indicators initially appear strong. That makes long-term planning much harder. Retailers are especially cautious now. For years, retailers relied heavily on predictable consumer patterns: holiday seasons, back-to-school shopping, seasonal spending cycles. But today, consumer behavior is far less stable. Social media trends influence spending rapidly. Online shopping changes demand constantly. Economic anxiety affects purchasing decisions quickly, and consumers increasingly prioritize value over impulse spending during uncertain periods. That unpredictability makes businesses nervous. Technology companies are facing similar problems. For years, many tech firms assumed digital demand would continue growing aggressively forever. Streaming growth, online advertising, cloud computing, e-commerce. Companies expanded rapidly around those assumptions, but eventually some areas slowed much faster than expected. Consumers became more selective, businesses reduced spending, growth rates normalized, and investors suddenly became less forgiving. That forced companies to rethink how much they could trust strong demand projections. Now many businesses are prioritizing flexibility over aggressive expansion. They want operations capable of adapting quickly if demand weakens unexpectedly. That means leaner hiring, more controlled inventory management, more cautious forecasting, and greater focus on efficiency instead of maximum growth. Wall Street is reinforcing this behavior too. For years, investors rewarded aggressive expansion heavily. Today, markets often reward discipline and profitability more. Companies that overexpand during temporary demand surges risk being punished later if growth slows. Executives know this, and they increasingly fear becoming overextended during uncertain economic periods. That's why businesses now seem more cautious even during strong earnings periods. There's also a hidden psychological shift happening inside companies. Executives no longer fully trust stability itself. The modern economy changes too quickly. Consumer trends move faster. Technology disrupts industries faster. Economic cycles feel less predictable. Geopolitical tensions create uncertainty constantly. And artificial intelligence is accelerating change across industries even further. Businesses feel like they're operating inside an environment where conditions can shift suddenly at any moment. That changes decision-making. Companies become more defensive, more flexible, more hesitant to assume current demand levels will last. Even industries seeing strong growth today are acting cautiously because businesses increasingly believe volatility is now normal. Another reason businesses distrust strong demand is debt pressure. Higher interest rates changed corporate thinking significantly. Borrowing money became more expensive. That means expanding aggressively carries greater financial risk than it did during years of cheap capital. Companies are being much more careful about taking on long-term obligations based on demand that may not last. Because if demand weakens unexpectedly, debt becomes much harder to manage. This is especially important for businesses operating on thin margins. Retailers, restaurants, manufacturers, consumer brands. These industries depend heavily on stable spending patterns, and when spending becomes unpredictable, companies become cautious very quickly. Consumers are changing priorities too. After years of inflation and economic uncertainty, many households are becoming more value conscious. People compare prices more aggressively, delay unnecessary purchases, focus more heavily on essentials. Businesses notice these shifts immediately, and even if overall spending numbers remain strong, companies may still see warning signs underneath the surface. That's why many executives now talk more about quality of demand rather than simply strong demand. They want stable, repeatable, reliable consumer behavior, not temporary surges driven by trends, inflation, or short-term economic conditions. This hidden distrust is reshaping business strategy across the economy. Companies are focusing more on resilience than maximum expansion, more on efficiency than aggressive hiring, more on flexibility than long-term assumptions. Because businesses increasingly believe that strong demand alone is no longer enough to guarantee safety. In today's economy, demand can disappear faster than many companies ever expected, and that realization has changed how businesses think about growth entirely.